Understanding rate cuts, what they are and why they happen. Rate cuts are when a country's central bank lowers interest rates. Think of interest rates like the price of money. When the price is lower, it's cheaper to borrow. Central banks cut rates for a few reasons. One big reason is to boost a slowing economy. Lower rates encourage businesses to invest and hire. They also make it cheaper for people to borrow money to buy things like houses and cars. This spending helps the economy grow. Another reason for rate cuts is to fight deflation. Deflation is when prices fall for a long time. It sounds good but can be bad for the economy. Rate cuts can help prevent deflation by encouraging borrowing and spending. Central banks have to be careful with rate cuts. Cutting rates too much or too often can lead to problems. We'll get into that later, but it's important to remember that rate cuts are a balancing act. The stock market's reaction: do rate cuts always signal a bull run? Rate cuts can be good news for the stock market. When rates go down, borrowing money becomes cheaper for companies. This can lead to higher profits. Investors get excited about the potential for higher profits and often buy more stocks. Lower rates also make bonds, a type of investment that pays a fixed return, less appealing. This is because the return on bonds becomes less attractive compared to the potential returns from stocks. So some investors shift their money from bonds to stocks. However, rate cuts don't always mean the stock market will go up. Sometimes rate cuts are a sign that the economy is weakening. This can make investors nervous and they might sell stocks. The stock market's reaction to a rate cut depends on a lot of factors. It's never a sure bet. Remember, the market is always forward-looking. If investors think a rate cut is a sign of bigger problems, stocks might not go up. The ripple effect: rate cuts and their impact on borrowing. Rate cuts have a big impact on borrowing, both for individuals and businesses. When the central bank lowers rates, it becomes cheaper for banks to borrow money. These savings are then passed on to consumers and businesses in the form of lower interest rates on loans. Think about getting a mortgage to buy a house. With lower rates, your monthly mortgage payments would be smaller. This makes it easier to afford a home, and more people might decide to buy. For businesses, lower rates mean they can borrow money for expansion at a lower cost. They might use this money to build new factories, hire more workers, or invest in new equipment. This can lead to economic growth. Business investment and growth: a boost from lower interest rates. One of the main goals of a rate cut is to stimulate business investment and economic growth. When interest rates are lower, companies have more incentive to borrow money for expansion. They can use these funds to invest in new projects, research and development, or hire more employees. Lower borrowing costs can also make it easier for new businesses to get off the ground. This can lead to more competition, innovation, and job creation. All of these factors contribute to a healthy and growing economy. However, rate cuts don't always lead to a surge in business investment. Sometimes businesses might be hesitant to invest even if borrowing is cheap. They might be worried about the overall state of the economy, uncertain about future demand for their products or services, or facing other challenges. Section 5. Consumer spending. Feeling flush? Rate cuts and the consumer. Rate cuts can also put more money in the pockets of consumers. Lower interest rates on credit cards and other loans mean people have more disposable income. They might choose to spend this extra money, which can boost the economy. Additionally, lower mortgage rates can make it more affordable for people to buy homes. This increased demand in the housing market can have a ripple effect on other industries like construction and furniture manufacturing. However, just like with businesses, consumers don't always rush out to spend more when rates are cut. Factors like job security, wage growth, and overall consumer confidence can all influence spending habits. Section 6. Inflationary concerns. Can rate cuts overheat the economy? While rate cuts are often used to stimulate economic growth, there's a flip side to consider: inflation. When the economy heats up too quickly, prices can rise rapidly. This is known as inflation. Rate cuts can contribute to inflation because they encourage borrowing and spending. When there's more money circulating in the economy and demand for goods and services outpaces supply, prices tend to go up. Central banks walk a tightrope when it comes to rate cuts. They want to encourage growth but also need to keep inflation in check. If inflation gets out of control, it can erode purchasing power and destabilize the economy. Section 7. The balancing act: rate cuts, recessions, and economic stability. Rate cuts are one of the tools central banks use to try to keep the economy on an even keel. When the economy is slowing down or at risk of falling into a recession, rate cuts can be used to stimulate growth. A recession is generally defined as 2 consecutive quarters of negative economic growth. It's often characterized by job losses, reduced consumer spending, and a decline in business investment. Rate cuts can help to counteract these trends by making it cheaper to borrow and encouraging spending and investment. However, it's important to note that rate cuts are not a guaranteed solution to economic problems. Their effectiveness depends on a wide range of factors, including the overall health of the economy, consumer and business confidence, and global economic conditions. Section 8. Rate cuts and stock market returns, a historical perspective. Looking back at history, the relationship between rate cuts and stock market returns is not always straightforward. While rate cuts can create a positive environment for stocks, other factors are also at play. In some cases, rate cuts have preceded periods of strong stock market performance. This is because the rate cuts help to boost economic growth and corporate profits, which are key drivers of stock prices. However, there have also been times when rate cuts have failed to prevent stock market declines. This can happen when the cuts are seen as a sign of desperation by the central bank, indicating that the economy is in worse shape than previously thought. Section 9. Investor Takeaway. Navigating the uncertain waters of rate changes. Rate cuts are just one piece of a complex economic puzzle. While they can have a significant impact on the stock market, it's crucial for investors to consider the broader economic context. Trying to time the market based solely on rate cuts is rarely a winning strategy. Instead, investors should focus on building a diversified portfolio that aligns with their long-term financial goals. Remember, rate cuts are not always a sign of smooth sailing ahead. They can also be a signal of rough waters. By staying informed, being prepared, and focusing on the long term, investors can navigate the uncertainties of the market with greater confidence.